And I'll welcome back to the platform Ben Cahill from the Center for Strategic and International Studies. And Ben, I'll let you introduce your panel.
All right. Thank you, Professor Allen. I'm really pleased to be here on this panel. We're going to pivot a little bit from talking about methane measurement technologies and QMRV programs to a more commercial discussion about operationalizing differentiated gas, both domestically and internationally. And I'm really pleased to be welcoming a great panel to do this. We have three panelists. You only see two of them here. One of them is Professor Jonathan Stern. He's a distinguished research fellow at the Oxford Institute for Energy Studies. He couldn't be with us here today, so he recorded a video, which we're going to show in just a minute. Many of you probably know Jonathan. I think of him as kind of the dean of global gas analysts. He's someone who's really known and respected in the gas industry and in academia too. We also have Ed Lush, to my immediate left, who's Director of Business Development and New Energy Ventures at Williams. And we have Keith Shoemaker, who's SVP for Commercial at EQT. Both of these guys have been involved in trading and commercial operations for a long time, and they've got a lot of really rich insights to add. So I think at this point, we'll turn it over to the video and hear what Jonathan has to say to kick things off.
Hello, everybody, and great to have this opportunity to speak to you. I'm so sorry I'm not able to be with you in person due to difficult schedule this week. I wanted to just spend a few minutes setting out where I think we are with trade in differentiated gas and LNG, and what I think the prospects are. So you all know what I've put on, what everybody agrees. The importance of methane, and I'm not going to spend any time on that. I just wanted to show you this range of government and corporate initiatives, which again I'm sure you're all familiar with. Just to say we are not short of initiatives which have been signed by large numbers of companies and governments. I'll talk about that more in just a second. But the real question that we're asking ourselves here in our group is, but what progress has been made by governments and companies to actually reduce methane emissions in general, and particularly here from LNG trade? And what can we expect over the next few years? So here's a couple of examples of probably the most important examples. The Global Methane Pledge signed at the COP before last to reduce emissions by at least 30% from all sources by 2030. And what you see here is that the pledge has got 150 signatories, but China, India, Russia, etc., are not amongst them, which is a bit of a problem given how important some of those countries are. And basically, when you look at the biggest corporate initiative, Oil and Gas Methane Partnership, OGMP 2.0, you now have 113 member companies, but 100 of these are in Europe and the US. And when you look at the other parts of the world, the other regions, we're talking about, in Asia, 2 companies, in the Middle East, 3, in Africa, 1. So you've got to ask yourself whether on that basis we're close to what the IEA has been saying for some time, and indeed said last week in its new net zero publication. Are we close to reducing methane emissions from fossil fuels by 75% by 2030? I think you have to conclude that we may well have a problem in achieving that target, which the IEA says is a key to achieving net zero by 2050. Now, of course, 2022, particularly the period since the Russian invasion of Ukraine, has been a year of crisis where security concerns, especially in Europe, but also in Asia, have really taken over the agenda from environment and emissions, at least until we get past the current crisis. And that's been one of the big problems. Very briefly reviewing the regional and national regulatory regimes, and the international initiatives. I'm not going to talk to you about the US IRA because undoubtedly you guys know more about this than I do. So I wanted to just spend some time on what's been happening in Europe. And I'm aware that Ben Cahill may have spoken to you already about some of this, but I thought I'd just give you our take from what we're seeing from Brussels. So the emissions from shipping are to be included under the EU exchange trading system, emissions trading system from the beginning of next year. That's the reporting and charges from 2026. And that's going to include methane and, of course, nitrous oxide as well. And that's interesting. And it's also a very, very complicated regulation, which we're going to be writing more about in the next few months. What I can tell you is that the more you read the regulation, the more complex it seems to be becoming. But that is actually happening. What is the big one for us is the EU methane emissions regulation. And we started with the strategy in late 2020, which was a very aggressive document. When we got to the legislative proposal, that was a slightly less aggressive document. And the Council General Approach draft at the end of last year was again less aggressive, but the Parliament really tightened up a lot of things in its draft of May this year. So there's a lot of stuff which I'm not going to go into detail about on source level measurements, on super emitters, on leak detection repairs and repair surveys, flaring and venting intensity, and critically an import standard. Now, I'm sure that many of you are aware that the way this works in Brussels is there is a so-called trialogue between the European Commission, the member states in the Council, and the European Parliament. And that's how legislation is actually finalized in a consensus draft between those three. And that's what we're actually waiting for now, for that consensus draft to emerge. And I thought I would just show you, but not read out, what I think are the key paragraphs for the question of imported gas and LNG. And essentially, what you can get to read here is that the onus is going to be on the importers of fossil fuels to demonstrate compliance by the exporters. There is the possibility of a derogation if the Commission decides that a certain exporter has actually met within its own national boundaries a lot of these standards that have been set. But the problem with all of this, assuming it actually makes it into the regulation, the final regulation, is, yeah, great, but how will importers or the European Commission do any of this? And this is what we understand one of the big sticking points of the trialogue process is. So what we understand is that the big importers, particularly Germany, have said, well, you know, we will show that our importers have made as big an effort as they can to assess what the emissions of the gas or LNG that they're importing are. But that's got to be good enough for you guys, because they're not willing to agree penalties for anything other than reasonable efforts to assess what those emissions are. And this is, for me, the really big question, which is, how are European importers or the European Commission going to assess the measurement of particularly methane emissions, but greenhouse gas emissions in general, from their imports? And I think there could easily be disputes between the EU and exporters. In other words, the Commission might say, well, we think you've got very large emissions, and the exporters say, well, you're wrong, we haven't, our emissions are small. And it's a question of, well, how are you going to resolve that? And I've already had preliminary discussions with exporters who are not impressed by satellite emissions. So this is, I think, something which has got to be sorted out in time. But perhaps for you guys, it seems to me your situation or the situation of US exporters will be very much more favorable because the IRA and the development of MRV means that you will almost certainly be aligned with evolving EU standards, whatever these are. And that will probably give you a comparative advantage over other imported sources of LNG. So, what is the situation as we see it today with the methane regulation? Well, there's a big push apparently in Brussels to get this signed before COP28. The problem is that the big push may have to come at the expense of a not very impressive regulation in terms of actual applications. So whenever it arrives, we wait to see whether the prescriptive intensity target, that is particularly OGMP 0.2% emissions, whether that's actually in there. And if it's in there, how long are companies and governments going to be given to make sure that their imports achieve that? And will it even apply to imports? This is very, very important because, of course, unlike North America, actual EU production of gas is rapidly declining. Given that Norway is outside the EU, the UK is outside the EU, you've got basically over 90% of gas demand, even reduced gas demand in Europe, now being imported. So there's all of these difficult questions. What will the target be? Will it apply to imports? Will it include charges for emissions from imports if they don't meet whatever the standard might be? This is going to be, I think, very difficult to put in place. And if I had to guess, and it is a guess, I would say that substantial charges are unlikely before 2028. But it's possible that individual importing countries could introduce national standards before then. You might have heard the slogan which the European Commission uses of a sort of "you collect, we buy." This is aimed at trying to persuade companies and exporting countries to collect methane either from emissions flaring or fugitive emissions, and so that they can monetize it. And it's a great slogan, but we have no detail about how it would operate and indeed how it would be measured, reported and verified. So a big lack of clarity on almost everything involved in where we are in Europe for the regulation. Of course, we do have these methodologies, one from GIIGNL and one from SG in Singapore. And these were published back in November 2021, so getting on for 2 years ago. Then we have the Cheniere academic publications and their cargo tags. The problem with these methodologies, which are actually very good if you read through them, you can have some questions, but basically they're a good attempt to try and get a handle on emissions. The problem is that as far as we know, there's only been one cargo which is applied to GIIGNL and one cargo which is applied to SG in the last, well, since they were published 2 years ago. So it's clear that actually the industry has not been impressed enough with these methodologies to actually adopt them. And even if they had adopted them, there is a great deal of confidentiality. I'll just tell you that I attempted to ask the various parties involved in the two cargoes to let me see the cargo statement so that I could actually see what they collected, and I failed. So aside from that, we have the Asian carbon neutral LNG cargoes, which started in 2019. I've got a list of about 66, 67 cargoes which have been transacted, but it's very, very difficult to get any transparency. I have managed to get at least what those offsets have been, but no idea how the emissions were measured or how they're being reported or whether anybody verified them. So really, that situation is complicated and a little discouraging. It's also a big complication in that when you take a look at three seriously, significant exporters, Algeria, Nigeria, and Qatar, and this data is from the IEA methane tracker from earlier this year. And this is from total energy production. But you can see that actually the majority of Algerian and especially Nigerian emissions are from venting and flaring from oil, whereas the majority of Qatari emissions are from gas venting. So it's not absolutely clear that if you were taking, as the Commission might be, focusing on gas and LNG, you would be capturing the emissions from countries which have a great deal of associated gas and take their LNG from that associated gas. It's just one of the complications, but I thought it was interesting to compare these countries, despite the fact that the data from the tracker is, shall we say, fairly approximate, although, as I understand it, it hasn't been disputed by these countries, at least so far. So let me draw this to a close and go back to the question I posed at the start, which is, what progress have we really made in reducing methane emissions and creating MRV regulation which really can be applied? And I guess my answer to that is, well, we've recognized the problem. Most countries have agreed that action needs to be taken. We've had quite a lot of technical developments of emissions technologies, especially satellites and drones. But most of what's happened is where you guys live, and the US and I think Canada is in the lead because IRA has accelerated the need for accurate measurement and because there are going to be charges above defined levels of emissions. In Europe and in Asia, the energy crisis has really delayed this process. Methane regulation, we could get it this year. We'll get it certainly early next year, but it's uncertain whether the requirements and the charges will be stringent and how they're going to be verified. So my general conclusion is that with the exception of North America, progress has been slow and disappointing. There's a lot of importers who are nervous about antagonizing exporters by seeming to give them additional tasks and requirements. I think this could speed up when the EU has more market leverage. In other words, when the LNG market rebalances around 2026. And I think that if the EU is able to introduce intensity standards for LNG around that time, then the big Asian importers could follow. So thank you very much indeed. And again, apologies for not being with you in person.
Well, that was a very comprehensive overview by Jonathan, but a bit of a sobering one, I think. One of the key questions for me has always been, we know a lot of the action on methane reductions is going to happen on the supply side through regulations and other initiatives. But it's always been an open question how quickly the demand pull would materialize for lower emissions gas. And I think the conclusion here is it's slower than many people would like. And the general perception is that Europe is going to move faster than other regions, but it's still a bit problematic. So I think we're going to focus the rest of the discussion a little bit more on the domestic picture, although I know both of your companies have international interest and involvement, so I welcome that too. Maybe in the interest of time, we'll kind of dispense with opening statements, but I'll just ask a broad question to start. When you think about differentiated gas and the demand for differentiated gas, where's it coming from? Is it coming from regulators? Is it coming from investor pressure? Utilities and major gas buyers and some of their corporate net zero commitments. What's really driving the interest in this? And maybe we'll just go in this order. So I'll start with you, Ed, and then Keith, if that works.
Well, firstly, thank you to the MDL team for having me. It's been a great conference and a real pleasure to be here and speak to you today. In terms of where the demand is coming from, I would say it's coming both from the buy side and then the operators themselves, trying to differentiate their operations, differentiate what we're doing to lower our emissions vis-a-vis others in the industry and industry averages. On the demand side, particularly with the domestic utilities, there's a greater interest in understanding what supply chain emissions are. So some utilities have scope 3 supply chain emissions reduction goals, and right now the only way to avail yourselves of understanding what that target is against maybe which you're buying offsets is industry averages, which when you look at individual operators against an average, there's a very disparate performance. There's many operators that are well below the average, and then there's a few operators that are well above the average, and that skews the average. It's not representative of the actual supply chain emissions. So we're seeing domestically a lot of interest from the buy side. We can go into some of the challenges with why the market perhaps is a little bit strangled right now and what's needed to grow it. But the same thing on the LNG side as well, just to talk about the global market. We've been in discussions with various LNG buyers, and we've seen an interest in understanding what the supply chain emissions are. When I say supply chain emissions, I'm talking production as well as midstream, and going beyond EPA emission factor-based approaches, but really focused on measurement-informed inventories, measurement-informed calculations. It's going to be that granularity, that data quality, and that real-time component of the data as well, not maybe an annual certificate, but a certificate that's perhaps monthly, or there's some frequency where the environmental data, the environmental attribute, is tied to the operation. Because ultimately, when you talk about differentiated gas, the goal here is to incentivize ongoing emissions reduction. And if you have environmental data that's disparate, it's not connected to the operation, it doesn't necessarily provide the value for the buy side or the operator.
Keith?
So I work for EQT, and we're the largest natural gas producer in the U.S., producing some 7% of U.S. production. And as a company, a couple years ago, we made the aggressive pledge that we would be carbon neutral from 2021 by 2025. And that's a pretty bold and aggressive statement. So we have, as a producer, taking this initiative seriously and replaced all of our gas-fired pneumatic controllers with air-powered controllers. And we did that all in about 19 months. And we had an original timeline of 3 years, but did it faster and have it all complete by the end of last year. We reduced our methane emissions by some 40%. And the reason I'm giving you all this background is just to explain that the initiatives that I've seen so far in the market are coming from the producers. Producers know that they have a good product that is not just a bridge fuel to some sort of renewable paradise, but rather a baseline fuel that can supply energy to be a backup to renewables and also to be a significant source of energy for power generation. So EQT takes this very seriously, and having a large land base and inventory of some 20 plus years, we see ourselves as being a leader to show how natural gas can be a fuel for the future and not just for the present. So I've been involved in the differentiated gas market place for the 3 years that I've been at EQT. And what I used to think that natural gas was a homogeneous commodity, and now we're starting to introduce terms like differentiated. What do we mean by differentiated? And what we mean is differentiating it based on its methane emissions intensity. And where I think we can make giant strides to move this concept into the market is to educate the buyers as well as the regulators and the public as to what we really are accomplishing by having differentiated natural gas. What does that reduction in methane emissions really mean? And where I'm going with this, if you can take that reduction in methane emissions and then correlate that to a reduction in carbon intensity, and then tie it back to, as Ed was saying, people look at their Scope 3 emissions and getting it recognized as an offset to your Scope 3 emissions, then we have a reason for the buyers to want to procure gas that has been certified low methane emissions. So I think where we are today, we've done a lot of work. MDEL has been a great partner here, helping us work through the processes and the technology. There's different certifying organizations that we've been working with, MIQ, Project Canary, and now most recently we partnered with Context Labs. But the point being here is that we're at a point now to where we need to educate the market and the buy side and the regulators as to what the value add or what the end game could be here by lowering methane emissions and getting it recognized as a CO2e equivalent offset.
Keith, let me just follow up on that. You mentioned the work that you're doing with Context Labs to kind of join up emissions data at different parts of the value chain. And I think that's really important. So maybe you could expand and add some detail on that.
Well, the concept that they are using is a blockchain approach to data collection and data aggregation, so that, in my simple commercial terms, I like to describe it as a carbon intensity fingerprint. So every decatherm of gas that's produced and tracked through this process will have the carbon intensity along the entire fuel pathway: production, gathering, transmission, and beyond. So that is what we're doing in partnership with Context Labs, and they're the data organizer, and then packaging that into what I consider to be a carbon intensity fingerprint.
There's always a bit of a tension between sustainability issues and willingness to spend money on that and cost. And we heard from Jonathan that in the last 18 months, with all the energy security and price concerns around the world, some of the momentum around differentiated gas and efforts to drive down methane emissions from traded gas internationally may have been lost. So maybe you could both talk to us, starting with you, Ed, about cost sensitivity among different buyers, how utilities and other end users are grappling with this. What do you see in terms of willingness to pay for verified lower emissions intensity gas volumes?
Yeah, so we certainly see interest and willingness to pay for low emission measured carbon intensity gas. One of the challenges is the ability to pay here in the US with the utilities, where most states, if not all states, have low cost mandates. So the utilities are actually constrained by that. They have to buy the lowest cost gas. So if you have a program, a differentiated gas program that comes at a cost, there's a desire obviously to recover some of that cost commercially. There's operational drivers, but to cover some of the cost commercially. And the utilities are interested in paying the premium. They just don't have a mechanism right now to do that. And if you look at what that premium may be, this is a nascent market. I mean, those premiums maybe 3 to 5 cent range, not huge. When you look at that cost being passed through to customers, it doesn't even show up on a bill. So when we're talking about what's needed to grow this market and how you look at the cost side of it, we can talk about regulation, but there needs to be the market incentive as well, because regulation sets the floor, but there's many companies that are going well above and beyond regulation. And how do you continue to incent those companies to continue to invest in emissions reductions? How do you incent others who may just be at that regulatory floor to go above and beyond? So in my opinion, you need that push-pull. You need the carrot, you need the stick, but you need the carrot as well. So if this market can develop into a true premium market, and again, we're not talking vast premiums that are going to cost consumers a huge amount of money, but one of the most tangible, as Dr. Stern showed, tangible pathways to global goals on emissions reduction is to decarbonize the existing natural gas supply chain. And regulation gets you so far, but in my opinion, that market incentive can get you a lot further and get a lot more companies on board in taking some of the actions, frankly, that our two companies are taking to be leaders in this space and really demonstrate very low emission, in our case, supply chains across our assets.
Yeah, that's really interesting. So it's not just a pure cost issue. There's also sort of directives and mandates that utilities have to abide by. And if a utility has a mandate that says you must buy the lowest cost gas, they're sort of stuck. Yeah. So this brings it into the realm of public utility commissions and others who kind of set the rules for some of these utilities and end users, I guess.
And you'll see that in some of the RFPs that utilities will put out. They'll put out RFPs, requests for proposals for certified gas. And there's usually, you know, an item, or in the Q&A, you'll be told that, yes, they want differentiated gas, but the driver is the cost, ultimately. So it's a bit of this misalignment where the utilities, in many cases who we've spoken to, would like the data. They would like to demonstrate that they're using their purchasing power to drive meaningful impact across the supply chain, but they're somewhat constrained by existing regulation right now.
Just to add a little bit to that is when you look at the few trades that have taken place for either differentiated natural gas, certified natural gas, or the certificates themselves, and the price that Ed was referring to of 3 to 5 cents, to me, it is only giving lip service to the opportunity here, because it doesn't really recognize the value in a carbon equivalency of that reduction in methane emissions. So that's what happens, I think, when people talk about it wanting to have an impact on the greenhouse gas problems, but not actually doing anything about it, is having this voluntary market that says, well, I want to buy up to 10,000 decatherms a day of certified natural gas, when they actually buy 500,000 decatherms. So they're just testing the waters here. And I really think that in partnership with the utility buyers and the regulators behind them, and then the public, which we're serving, if we can do a better job of explaining to the public what the value is of this offset and this reduction in methane emissions, then we can come up with a value with a price that represents the true value here. And it doesn't have to be as a surcharge, because in a high price environment like we had last December after the Ukrainian invasion, you know, no one wanted to pay any more for their natural gas. That was the last thing that anyone could stomach. So there's probably a way, as Ed was referring to, we've talked about this, is kind of like a carrot and a stick here. If you're producing and consuming high methane emissions gas, maybe your gas should have a discount associated with it corresponding to a price of carbon in a compliance market. And conversely, if your gas is lower than the industry average, then maybe the funds that the dirtier producers are paying into the program could be passed on after whatever administrative fee is necessary to the low emissions producers. So I think that a carrot and a stick approach, maybe in the form of a cap and trade market, could be the fastest way to solve the problem with greenhouse gas emissions from methane.
Yeah, I mean, ultimately this is about emissions reductions, right? So voluntary industry initiatives and schemes that increase transparency are good, but if they just change hands and it doesn't really drive actual changes in operations that reduce emissions, what impact are they having? Right?
Yeah, they have to have tangible outcomes, and the way to do that is to hold everyone accountable and affect people in their pocketbook as a producer, you know, that will drive change. I think as an industry, and with your help here at EMDO, we can bend the curve on greenhouse gas emissions by setting up the proper market structure that will reward and penalize producers based on their methane emissions.
Yeah.
So I'll just add to that a little bit in terms of, in general terms, talking about a transaction that we've done and how that is tying the premium with the emissions reduction. So we're a midstream company, and we looked at the certified gas space and said, what role can we play? Primarily, initially, where this market, this product begun was focused on producers and partly to demonstrate responsibility in operations more holistically with a view to still being able to attract investment when they're trying to fund their drill programs and at a time when many producers weren't necessarily operating within cash flow. So we looked at the market, and we were actually partnered with Context Labs as well. They're our platform that ingests our data both to provide operational value and then to calculate the path-specific emissions across our assets. And we know that gas is produced in areas that are disparate, long distance from where the demand is. So as a midstream company, we felt we had an important role to play in this space. As you've heard others from Williams talk about, we on any day transport around a third of the gas that's produced in this country. So connecting the supply to the demand, and also looking to how we can partner with our producer customers to unlock differentiated gas value. And what we've experienced is 1 + 1 can equal 3. So if we're combining production certified emission data with midstream pathway specific data, that combined product is worth a lot more value to the utility, to the LNG buyer, than just a production certificate on its own. And in terms of where I began this comment, I rambled a bit, was some of the transactions we've done, they will have a methane intensity cap in them that for any month, so through Context Labs, this measurement program is on a monthly basis. So we will measure emissions across a commercial pathway on a monthly basis and then provide that data to the utility within 45 days after the end of the month. And there is a methane intensity cap in that contract. So to the extent that we collectively don't hit that cap, there's a financial penalty in the contract. They don't pay us the full value. So that's really kind of holding your feet to the fire and really connecting the commercial market incentive with the emissions reductions, and then unlocking collective value and encouraging, okay, if there's emissions controls that you may not have an obligation to invest in, but you can drive that for a producer, a midstream company, drive those emissions lower, and you can unlock more value, well then it's that snowball rolling down the hill. So it's a very, as I said, nascent market, but when we're looking at what the industry can do, what policy can do, what regulation can do, having that market incentive is, in my opinion, far more valuable and can do a lot more good than regulation can. It's just how we get there.
That's really interesting. So let me riff on that a little bit. You talked about data being provided between companies, right? But this raises a question about transparency of data across the value chain. Maybe you can both speak a little bit about commercial sensitivity of data and contracts between different counterparties versus making this data more open and publicly available. I mean, how do you think about that in terms of day-to-day commercial operations for an upstream and midstream player exploring this space?
Well, I think what is evolving here, along with the technology and everything, is the concept of carbon accounting, and to accurately recognize the environmental attributes of your production. And we have a team that at EQT's accounting department that's looking at this, and probably we will get direction from Europe too, because of the CBAM program that they're planning to implement here. But I think that coming up with a standard of the data that is needed to attest that you have low methane emission certified gas, that is coming, and as that develops, then that will be how a company like EQT organizes their data collection and accounting for the environmental attributes of our production. And I think that it will become a part of the transactions confirmations for the physical gas. If it's certified low methane emissions gas, it'll be documented on the transaction confirmation that, as kind of as Ed was referring to there, that the you'd have a minimum or a maximum level that the production could have in methane emissions intensity. But I don't think that we need a new contract to cover this business. I mean, It's not something that NASB needs to get involved in, I don't think. It's really something that buyers and sellers can come up with an acceptable amount of data and then monitor the performance of the production.
Yeah. Talk to me about the commercial opportunity here. So I know the global LNG space better, and my perception has always been that more or less an LNG cargo is a cargo. Like there's some differences in calorific content, but you've got a bunch of suppliers competing against each other, and anything they can do to gain an advantage, whether it's trusted customer relationships or ability to drive down costs, they'll do it. And so lower emissions intensity is a potential differentiator. I mean, the cargo emissions tags that Cheniere is offering, that was a real differentiator. They put the pieces in place to be able to offer this product, well before there was actual strong demand for it. So what does this mean in terms of the commercial potential for Williams and EQT? Do you need new people, or are you sort of adding different sort of metrics or performance into what you're looking for from trading operations? Like how does it affect the way you think about your commercial operations and trading ops?
Well, we have about 20 traders that are moving around 7 BCF a day. We trade in and out of about a BCF a day, well over 200 trades. And I could honestly say, outside of a separate RFP, request for proposal, methane intensity never comes up in those daily, trading, chats. It just doesn't come up. So what I've embarked on for over the next year is getting out and talking to our customers and explaining to their sustainability people of what the impact could be if they bought either the certificate or the physical that's certified low methane. So commercially, it's not the people who buy and sell decatherms that are that concerned about this, but it's the ESG people and the environmental people at the buy side that should and will have, see the real value of this and to help drive their business going forward.
Yeah, emissions reduction is core to our company, and we were the first large midstream company, I believe, to make a climate commitment. We had the first U.S. midstream company. Cheniere has midstream assets, but pure play midstream company to join OGMP 2.0. Emissions reduction is tied to executive compensations. This is core to our business. This isn't something we're just doing to make a little bit of money. We have a trading group called Sequent Energy, which is a trading division under Williams. And whether it's a tangible premium for the differentiated gas, we have got buy-in from the traders. They're seeing differentiated gas as, no pun intended, a differentiator to open doors to perhaps transactions that they wouldn't necessarily get, whether they're managing transportation capacity for utility or someone else. So we do see value across the company, even in our trading team, the tangible value and then the intangible value. But as I said previously, the real goal here is to just drive the emissions lower. And through the Context Labs platform, ingesting operational data, bottoms up, top down, reconciling, really providing the learnings we can to continue to tell the story we like to tell about natural gas and the good natural gas, the role natural gas can play here in the US, and more importantly, globally, to help the world decarbonize and reach some of these lofty pledges that we have in place right now.
Let me ask more of a 10,000-foot question here. When you think about the long-term potential for differentiated or lower emissions gas, both domestically and internationally, feel free to adjust either one. I mean, what are the barriers to making this a bigger thing? Is it data quality? Is it lack of accessible data that's kind of trusted and has spread throughout the marketplace? Or is it the lack of that policy and the policy push in different regions to make it happen? What do you think is constraining it from growing faster and spreading throughout the market faster?
I'll jump in. I think it's a little bit of all of the above.
Yeah.
From the perspective of currently, many of the certification programs don't have that granularity of data that is driving the value that a utility hypothetically can say, I'm going to go to my commission and seek approval for a premium because look at this great data. That's been lacking as well. one of the challenges and the role MDALE can play, and we heard Assistant Secretary Crabtree talk about the DOE framework, is there's lots of different approaches out there, certification programs. They all have their pros, they all have their cons. I'm not going to pick winners or losers, but that has created some confusion in the marketplace as to how do these different certifications really compare to one another. And in many cases, there's not that level of transparency with those certification programs to understand what they're doing and how they do it. And then that third-party validation piece to make sure there is some form of framework, and it can be OGMP 2.0-like, where it's principles-based versus rules-based, but some standard approach to how we're going about truly measuring emissions intensity across the supply chain.
Yeah, I would agree with that. It's both. It's data, transparency, but I think it's also getting recognition of the value add by differentiating the gas based on its methane intensity. So it's all of the above. But in order to get buy-in to that, you've got to get the regulators and the buyers to understand that this is a way to solve the problem, and ideally use it as an offset against their Scope 3 as a consumer or a burner of natural gas.
Great. I have a ton more questions, but I think we're out of time because Dr. Allen is standing up again. So it's great to hear from important voices in the midstream and upstream space innovating on the commercial front. Really grateful for your time, for being with us. Please join me in thanking the panelists.